Hello everyone, hope you're doing alright. Welcome back to this new video. Today we are going to touch on market structure for a little bit. Now I'll be going mainly over, because I think that's where most people struggle with, intermediate term highs and intermediate term lows. So again, obviously I'll make it in simple steps for you to understand as easily as possible. So let's get right into it. What exactly is an intermediate term high or an intermediate term low? The first thing we know, an intermediate term high is a high, for example, this swing high with another swing high lower to the left of it and another swing high lower to the right of it. For example, this would also be an intermediate term high. It has a lower swing high to the left of it and a lower swing high to the right of it. Same goes for this one, same goes for this one, same goes for this one, and same goes for this one. Now for an intermediate term low, obviously it's just the opposite. So for an intermediate term low, it has to have a higher swing low to the left of it and a higher swing low to the right of it. So that will make this low right here an intermediate term low. The same as we just saw just on the opposite side. This would be an intermediate term high. This would be an intermediate term low based on the swing lows to the right of it and swing lows to the left of it. Same goes for this low, intermediate term low. Same goes for this low, intermediate term low. So you can already probably tell how the intermediate term highs and intermediate term lows are at the outsides. They are at the external range liquidity. And everything in between is either a short-term low or it's another intermediate term low, or of course intermediate term high. So what's the second thing that makes it an intermediate term high or intermediate term low? Well, if we rebalance a fair value gap and displays away, then the high, for example this one, this high would be considered an intermediate term high. That's why I wrote FVG and a 2. 2 indicating the two swing highs for an intermediate term high to the left one, to the right one, that makes it 2. For a FVG to rebalance and displays away, that would also make an intermediate term high. Now you might have noticed why, if this is an intermediate term high, because like ICT says a lot of the time, an intermediate term high or intermediate term low should ideally hold, otherwise your ID might be flawed. But why is it that this intermediate term high just got swept? Well, this is where my understanding comes in, and this is where my own studying comes in. If you also want a better understanding of this, then instead of just watching me, also apply the things I'm going to tell you right now into your own charts. If we understand both rules of how an intermediate term high and intermediate term low gets formed, then let's take a look at this situation right here. First off, we always need a draw on liquidity. So one draw on liquidity. Of course, without a draw on liquidity, we are basically blind. We are trading blind, and we're basically trading in low probability conditions without a draw on liquidity. No worries, I'll also make another video on draw on liquidity. I'm going to be making more videos on YouTube as of now, because I think they are way more beneficial for you all than just a simple Twitter educational post. So to keep you updated and to help me out, please do consider to leave a like, subscribe, and put your alerts on. That way you will get notified if I upload a new video. Thank you. So first off, we need a draw on liquidity. Let's say this right here was our draw on liquidity. And what is this? This is our intermediate term low. Now, as you might have noticed as well, this high right here swept this intermediate term high, coming into this fair value gap right here. Now on the daily, this is an intermediate term high because it rebalanced a fair value gap, and it has a swing high to the left of it and to the right of it, of course lower. Now let's study our draw on liquidity and how we deliver there. If we zoom in right here, we see our first market structure shift right here. Then we come back lower, we have this small fair value gap right here. We rebalance it right here and then push lower again. What does this make? An intermediate term high. Next thing we know, we respect this intermediate term high, coming into the premium as well, and then displacing lower again. Now when we displace lower, we of course leave behind this new fair value gap, which we then retrace back into, making another intermediate term high and then displacing lower again. So if we draw our Fibonacci again, we come back into premium of this short-term range, into the fair value gap that's also located in premium before taking out the draw on liquidity. And that's very important for you to acknowledge. Before we take out the draw on liquidity, we come back into the premium of the short-term range and then drop lower, which make this an intermediate term high. But next thing I'm going to say, because we now took out this intermediate term low, aka our draw on liquidity, what is the next thing we could expect? So we talked about these outsiders. These highs and lows are outsiders. They are external range liquidity. Once we've taken this draw on liquidity, and you can probably see very clearly, there's nothing clear to the left right here. You have to go very far back to look at some price action that will be very forced. Now, if we take a look at this, these outsiders, as we call them, if we now draw our Fibonacci from this intermediate term high to this intermediate term low, we can see how price comes back to premium, sweeping this buy side liquidity, aka the swing high, so sweeping liquidity into this fair value gap, into even the BPR, balanced price range, and then dropping off. So as you might have noticed, if we are on our way to our draw on liquidity, the short-term ranges right here tend to get traded back into premium and respected. Then the intermediate term ranges, once we take out the intermediate term low, if we're bearish, we can expect a deeper retracement into premium of this intermediate term range. What makes this an intermediate term range? Because it's from this intermediate term high that took out this intermediate term low. So if we are going lower, we should not trade above this intermediate term high. And now you might think, but Arjo, this was also an intermediate term high, right? Yes, but this is something I've noticed myself. If we are trading to the draw on liquidity, every short-term range will get respected right here. For example, this intermediate term high that we just talked about will get respected. This short-term high will get respected. Then this will get respected until we take out an intermediate term low right here. So if we know this, our draw on liquidity was the first thing we needed to have. Then the next thing, well, obviously a market structure shift. The next thing is short-term ranges start to form. And short-term ranges will likely get respected until we reach the draw on liquidity. And then the process starts all over again. So here, draw on liquidity reached, and the process starts all over again. So we need to get to another draw on liquidity. So now let's say we were bearish again and establish a new draw on liquidity. This draw on liquidity would be nice, this low. Now let's look at the same thing again. We swept this swing high into this fair value gap as well. We are not body closing above it. We are displacing away, market structure shift again. Then the next thing, we are coming into this area of resistance. This short-term range right here should hold until we reach the draw on liquidity. Now, next thing we notice, this becomes our intermediate term high. So where does price retrace to? It retraces to a fair value gap within premium of the intermediate term range. See how price returned into premium of this intermediate term range, then displaced away. This becomes our new intermediate term range, which we then displace away again. Now this becomes our new intermediate term range with our new draw on liquidity right here. So again, let's take a look at this new range right here. What happens right here? We are coming into this fair value gap. We have a new market structure shift. We then create this high, this new intermediate term high. But remember what we talked about, this high that rebalances this fair value gap will likely be protected until we reach the draw on liquidity. Same goes for this high. So once again, we have this new intermediate term range right here. Now, and obviously, as we just saw, we swept this intermediate term high and are now dropping lower. What does this become? This is a new intermediate term high. This should hold until the draw on liquidity is met. So I hope that does make sense. Let me go over it one more time in another example. This is of course a little bit more advanced. If you do not fully understand this the first time watching, then don't worry. That's completely normal. Just watch the video another time or come back at a later point. Let's take a look at the same thing that we just noticed. Once we take out an intermediate term high or intermediate term low, we can expect a deeper retracement into possibly discount or premium. So if we look at this situation right here, we have this intermediate term high right here, right? All right, these intermediate term highs that rebalance a fair value gap, they get respected right here until we reach the draw on liquidity. Perfect. Then this is our intermediate term range. This intermediate term range gets traded into premium, into a fair value gap as well. Perfect. We displace away again. And now we sweep this low. Now, if we want to go lower, what high should likely get respected? This high, because this is our intermediate term high, making this our intermediate term range. See how we now disrespect this? Instead of sweeping it, we disrespect it. Now, what's our next intermediate term range? This right here. Notice how we are coming back into discount again and then pushing higher once we took out this intermediate term high. So intermediate term high taken or intermediate term low taken, bigger retracement can be expected. Of course, don't force anything. We are not calling the top here. We are not calling the bottom here. We are waiting for the retracement to continue trading with the higher time frame trend. Now, if you combine this with my last video on breakaway gap, then this is a very strong and very advanced way of looking at price action. Then this will likely help you a lot at looking at price action. And this could make a major difference in how you view your price action. So let's look at one more example of how price respects fair value gaps, creates intermediate term highs that are within the intermediate term range. And once the draw on liquidity is taken, we'll likely see a deeper retracement. And these ranges that rebalance an intermediate term high will not be as safe as this intermediate term high. So let's look at one more example of how price rebalances fair value gaps and respects the high or the low that rebalances a fair value gap until we reach our draw on liquidity. And then we can likely expect a bigger retracement, but the intermediate term high, the high with a lower swing high to the left of it and a lower swing high to the right of it, that's the high that will likely get respected in the long term. And the intermediate term high that rebalances a fair value gap while price is trading to the draw on liquidity, that might not be safe and will have more chance of getting taken out. All right, so here we are on our last example and another piece of price action. As you can see, this is an intermediate term high. Here we rebalance this fair value gap, we displace away this intermediate term high, now holds until we reach our draw on liquidity, which is this low, this low right here. This displacement and this fair value gap gets rebalanced right here, displace away again. Now this fair value gap also, according to the rules, becomes an intermediate term high, but because of what we just spoke about, we can likely expect this intermediate term high to get taken out for a deeper retracement into this intermediate term range and then possibly displace away again. Now this is a sort of fractal situation of what we also saw on the daily before, because here we sweep this low or make some kind of equal lows and then push higher. Now if we had this draw on liquidity after we reacted accordingly, after we saw this, notice how every fair value gap in here acts as support. We make a swing low in these fair value gaps. We displace away. These intermediate term lows now should hold until we take out the draw on liquidity. This low, this low, this low. Now, once we take out the draw on liquidity, aka the other intermediate term high, remember the two, aka a swing high to the left of it and a swing high to the right of it. Once we take that out, we can expect a deeper retracement. Until when? Until discount. We come into some sort of support right here. And again, same thing happens. This low rebalances a fair value gap. This acts as support until we take out the draw on liquidity, which is, again, remember the intermediate term high right here. And again, here the same happens. Now, if you do want to study, I do highly recommend it, studying this yourself, and you can apply it on this piece of price action right here. This is the 31st of March on AUD USD. Go look at this price action with the same principles we just went over and see if you can understand it. Don't worry, don't get frustrated if you don't understand it the first time. Just rewatch it and just study for yourself, make your own logic, and that's where you form your own edge. So I hope this was insightful. I hope you learned something, and I'll see you at the next video very soon. Thank you.